Hello everyone, I am Ramachandra Bhubadi from MS Trading School. This is the second episode of our podcast series. Before getting into the podcast, let me give a brief overview about MS Trading School. At MS Trading School, under the guidance of Dr. Lily Sharma ma'am, we are creating professional traders. With our trained teachers, we make sure that the students have high exposure in live market sessions and practical sessions. To know more about MS Trading School, kindly check out our app on Play Store. Now let's get into the podcast. Our guest for today is a SEBI-Registered Investment Advisor. He has over 22 years of experience in finance and financial markets, and he is a professional who's known to have research-backed insights and an expert in personal finance planning too. Let me welcome Mr. Shankar. Welcome, sir.
Welcome. Thank you very much. Really appreciate for you to invite me and happy to do this podcast. I'm hope that all your students and all your listeners and the followers hope they enjoy this and take away quite a bit of insights with respect to personal finance.
Yes, sir. Sir, to begin this podcast, could you briefly take us through your journey? Because you have a lot of experience in yourself, so you better narrate it yourself to the audience.
Okay. So I throughout my career, like close to 22 years of corporate work experience, I've been a financial analyst in one form or the other. I've worked under different entities. I've worked for stockbroking firms. I've worked with MNCs, multinational corporations. I've worked for a PR firm also. I've worked as a journalist, but everywhere financial analysis was the core basis of whatever I did. Out of these 22 odd years of experience, close to 15 years has been pure equity research, where I used to interact with clients, institutional clients, which means mutual funds, hedge funds, private equity funds, and even international investors. So I've traveled to US, Europe, Hong Kong, Singapore to meet investors continuously and explaining them the rationale about which stocks to buy and what not to buy, all of that. So that has been my predominantly how I have been trained into financial markets in that sense. Having said that, in 2016, I left my job with a conscious effort, saying that at least for money, I don't have to work. And it was through a planned way how I went about it. And closer to 2020 onwards, I've been actively trying to help people in terms of simplifying of how to go about looking at personal finance and investments and busting lot of myths surrounding personal finance. And when I'm saying personal finance, it's not only about investment, it's about insurance. It is also about loans. It is also about how to define your goals, financial goals, and how to start saving for it and choosing the right vehicle, and more about how to do risk mitigation. There are various misconceptions about how to go about doing risk, handling risk, and all of that. That's one. And lastly, I've been a very strong proponent of writing a will. The sooner and people realize it about it, that is better. And trying to also explain what kind of loans are better, what kind of loans one should never take, all those kind of. So it's like a 360-degree perspective about uh, money, if I could put it that way, and that's it.
Okay, sir. We will
So
discuss.
currently I'm a formally certified and registered investment advisor with SEBI. So I've got both certification through NISM and I've registered with SEBI, and that I've been doing it for the past 3 years.
Okay, sir.
Prior to that, I used to do it when the rules were not there, but at that time I was not in that kind of a professional manner. But now it is like a full-fledged professional manner. I'm doing a SEBI registered investment advisor. Yeah.
Okay, sir. We will discuss about all these things, covering all those areas, sir. Sir, in this whole journey, you would have met a lot of people. So my question is, why do most people, especially people who earn well, don't have control in their finances today? Because there are a lot of things surrounding around personal finance. We need to budget, we need to fix our goals, we need to allocate funds for every aspect like insurance, emergency fund. Why do people lack control over their finances?
Oh, the most simple answer for that, and which you're absolutely right. Like more than 90, close to 90% of my clients also have noticed that. Practically, most of them do not know what is their lifestyle cost is.
Yes.
In other means, what is the cost of living?
Okay, sir.
The expenses in their day-to-day life, they are not on top of it. For example, let me try and give you through a numeric number. If I were to ask somebody today, what is their cost of living? And assuming that individual says 1 lakh rupees per month.
Okay, sir.
Okay. I have developed a tool, Excel tool. I'll just quickly share it with you.
Okay, sir.
Can you see it?
Yes,
So
sir.
this is a list of 45 items which are put together. These are all things that one incurs in their day-to-day life.
Okay, sir.
So when I give the sheet to somebody, that 1 lakh easily becomes 1 lakh 50, 1 lakh 80 kind of thing in a month. So that is how the deviation is.
Okay, sir.
Okay, if you're not on top of your lifestyle, if you don't know how much it costs to live your normal life, then irrespective of the goals, irrespective of anything, you're not going to meet them. Because whatever you earn, you don't even know where it is going. And hence you're not able to save the way you wanted to target. So your budget goes haywire, your goals go haywire, you're not able to meet your targets or any of those things, which also causes lots of stress. So whether I take an adequate, even if I take a 1 crore insurance cover, it might be inadequate. If somebody has some health issue, their mediclaim can be inadequate. So everything hinges around this. And through my own personal experience, I can confidently say if somebody is on top of their expenses, if they know up to the nearest thousand at least in terms of expenses, close to 70 to 80% of your personal finance and investment related issues will get sorted. You master this sheet, your foundation is strong. At least you know where you stand. So a lot of other things falls into place.
Okay, sir. I understand, sir.
If you want, I can share the sheet, which you can circulate. So I know that it might sound it pretty premature to write now, but there is too much of power in this. And so even for a student who's starting off right now, they will at least know what are the various costs involved. So some of them, they may not incur now, but they are likely to incur going forward. That's one way of looking at things. Even their own cost, whatever they are incurring today, they will know what is the true cost of it and how it impacts their lifestyle. But they can always use this from their family perspective. They can take home and discuss with their family members, with their parents or whomsoever is running the house, this is what has been found, and if they can start using it. So at least the ball sets rolling in that sense. In that sense.
Sharing this will be more helpful, sir. Thanks for saying that.
I'm
So,
happy to do this.
okay, sir. So you mentioned about we should know about what we need and what we require on our day-to-day life. But most money decisions are driven by emotions, especially those two emotions, fear and hope. So what's one emotional pattern that you have seen over the years in people that's holding them back the most in finance?
Actually, this is like an exaggeration. If you ask me this fear and hope, the fear and hope is entirely because you do not know what I just said, how much you want.
Yes, sir.
Okay, and this how much you want is happening because you don't know what is your true cost is. If I were to tell you this is your cost of living and you can track it on a monthly basis, yearly basis, you can track it. It is also reflected in the amount you save
Yes.
every month because what you get, what you spend, and what you save. If everything tallies, so then there is no fear in that sense because you know if you can put a pen to paper, you can list down each and every item of your life, whether it is your routine expenses or your goals, because your goal is also linked to your lifestyle.
Yes, sir.
Okay. For example, your lifestyle determines what kind of house you live in.
Yes, sir.
Your lifestyle determines what kind of vehicle that you buy. Your lifestyle determines what kind of vacation you want to take. Your lifestyle determines what kind of college that you go for post graduation and other. So everything is hinging on that.
Yes.
Once you know the answer to this, it will eliminate lot of the fear that you have been talking about, and then you don't have to live on hope. You're far more confident of living your life in that sense because you know exactly what to do. You know exactly which problem to address. Prioritization also happens. What to address first, what to address late. So it's a kind of a myth. I'll just extend your point to a bit later, to further in the saying that it's a myth that finance is an art. It is actually not an art. It is a science. It is not a perfect science. It is like an imperfect science, like economics. So
Okay.
if you start approaching finance and especially investment, like a science, and you take the step-by-step approach, and if you try and quantify each and every issue or each and every thing that you face in your life with respect to money, there won't be any fear. Trust me, there won't be any fear. You will be able to live much more confidently, and you'll be surprised, which is once again my own experience with my clients. Almost all of them have achieved their goals either ahead of time, which they had anticipated, or with lesser money with respect to their goals,
Okay.
or both combined. They have done it both faster as well as with lesser time.
Okay, sir.
So if you do plan well, it's far more easier and simpler, and it will not complete. It is not a rocket science. It's a far more simpler science.
Okay, sir. I understand your point. But I have also this doubt, sir. I think in psychology of money, there is a point that we should not compare our finances with others. Finance is different for every other person. So I feel this comparison is the factor that infuses fear in people. So what's your point on this, sir? Is comparison the
So,
reason
like I
expected?
said, yeah. So when I give you this Excel sheet or this Excel file, every individual will have their own lifestyle cost.
Okay, sir.
It is not comparing to each other. So so the comparison stops.
Okay, sir.
I will give you once again an extension of this example. So there are individuals, two individuals. Let us assume there are two individuals who join a company
Okay, sir.
after their graduation. They both have the same qualification. They are in the same age group. They are entering the company for the first time. So obviously that package is also same, right? The earning salary cost to company is also the same. But their cost of living is different.
Yes, sir.
Okay. The way they live their life, somebody might be living lavishly,
Yes.
somebody might be spending much more in terms of social activity or other something habits or vices, whatever vices he might be having, he or she might be having. The other individual might be consciously saving much more and living with a tight budget in that sense. So the lifestyle of both the individuals are different. So there is no comparison. The only comparison, they both came from the same education, same educational institute. They are of the same age. They have started on the same level. So, but the one person is already ahead in terms of their achieving their financial goals. The other person is significantly behind in terms of achieving the financial goal. So the comparison is not at all there. If you know your lifestyle, there won't be any comparison because your lifestyle is totally different from your colleague's lifestyle. I will go ahead and say a bit more. Even if there are twins, their lifestyle will be different.
Yes, sir. I
Okay.
understand.
What each and every individual want from their life will be different.
Okay, sir.
So, hence, the entire argument that comparison causes all these things falls flat. You don't have to compare because you need to know only what is your stuff in
Okay, sir.
that sense.
Okay, sir. Sir, my next question is regarding emergency funds. So,
Yes.
what's the right way to build an emergency fund and where can we keep it? Because some people have it in gold, sir, because they can quickly pledge it and make it out money, make money out of it. So, what's your view in this, sir? What's the best way to have an emergency fund?
Okay. So, I will address this in two fashion. First is how much you require.
Okay,
That's
sir.
the easier part. So the way I normally answer this is if you are a working salaried individual, then you should try and at least start with 3 months of your expenses, not your income. 3 months of your expenses,
Okay.
you should have it in emergency fund. And as your career progresses, try for 6 months.
Okay.
If you are a salaried individual, if you are a self-employed,
Okay.
and it's a startup, and you are still in the initial stages, that it is not, you're not started doing well, it is still bootstrapped, or you're not making money, then you need to eventually, you need to get enrolled in that startup only after you have 2 years of emergency funds. In terms of, once again, expenses.
Okay.
All I'm talking about is expenses, not income.
Okay, sir.
Because then you will be confidently working in your startup. You will not get bothered about how will your household expenses will run, how will you meet your certain other commitments. You will not be under that pressure
Okay, sir.
if you are a self-employed in the starting. But having said that, once your startup does well, or once you are a self-employed, but there is a recurring source of money, your your all the other expenses are taken care of as far as your business is concerned, then you should have 1 year of expenses as emergency.
Okay, sir.
Okay, so I've given all the scenarios.
Yes,
The
sir.
second most important thing is where to deploy this. Now, this is entirely contingent on the risk profile of the individual. Okay. If the individual does not like mutual funds at all, so then, but that individual likes only, they trust only the banks. So then keeping it in a fixed deposit is the ideal thing. If they know only about banks. Okay.
Okay, sir.
But like you said, if that person does not even trust the banks, they like only gold. So then go and buy physical gold, not the jewelry, physical gold.
Okay, sir.
So you should have physical gold equivalent to whatever the calculation I said.
Sir, physical gold
But
means coins and bars like that.
yes,
Okay, sir.
because if you buy jewelry, then there will be making charge. By the time you have to go back, there will be some deduction. There
Yes.
will be some mix of all of that. That's the reason to avoid that.
Okay,
Because
sir.
it has the physical gold has a hallmark, 916 hallmark.
Yes.
If it's a 24 carat or 22 carat, you will get the entire price. There won't be significant haircut into that. If you go to anything else, they will say that this jewelry was made in that shop. I don't accept this. There is this kind of impurity. There is this, there is that. Whole lot of issues happen.
Yes, sir.
But if somebody is comfortable with mutual funds, and especially equity mutual funds, then according to me, the best instrument is an arbitrage fund.
Yes, sir.
It's the most tax efficient way to have your emergency funds.
Okay, sir.
But if they are still very, very apprehensive, they don't like equity mutual funds at all,
Sir.
then obviously you can prefer debt mutual fund, any of them. But that is a very tax inefficient way of doing it.
Sir, sorry for interrupting. Can you give a brief view about arbitrage fund? What are they and how people can know about that? Because it will help
Okay.
users.
Okay. So the arbitrage fund, the way the name is, it is trying to price in or trying to encash on the difference between two scenarios.
Okay.
Now, what are these two scenarios? First of all, arbitrage fund from a tax purpose is treated as an equity fund, equity mutual fund. Okay. Now, what are the two scenarios? You have two exchanges, Bombay Stock Exchange, National Stock Exchange.
Yes, sir.
So if the price of the underlying security is difference between the two, then that's an arbitrage.
Yes, sir.
Okay. The second scenario, if there is a price difference between the derivatives contract and the cash contract, F&O price and the cash price.
Okay, sir.
That's the second scenario. Third scenario, if the underlying stock or security is going to get introduced in an index or withdrawn from an index, okay, that will create a pricing difference.
Okay, sir.
That's an arbitrage. Fourth, if a company is going to announce a certain development of either, let us assume, merger, acquisition, hive off, or hefty dividend, split, any of the corporate announcements. If that is going to lead to a price difference, has led to a price difference between both cash and futures or whatever, or between the timing of the situation, once that happens and now, that is also an arbitrage. So these are the situations based on which these funds invest.
Okay.
Arbitrage funds invest in such scenarios. So at any point of time, they are not fully exposed on one direction. It's perfectly hedged. So there is nothing much to lose. And normally the window period is not more than 2 or 3 months. So it will normally track. And if you look at the performance of almost all the arbitrage funds, there is hardly any difference in terms of the returns. And most importantly, the returns are very close to FD rates, fixed deposit rates, but the taxation is equity taxation. So hence it becomes very useful instrument to do it.
Okay, sir.
But ideally, if somebody wants to invest in an arbitrage fund, the way to choose a scheme is one which has the best performer, one which has the largest AUM and an excellent track record under different cycle in that sense. And obviously compare their cost structure in terms of expense ratio or in terms of the turnaround and all of that. The lowest expense ratio, highest AUM, and the good track record is the best in that sense.
Okay, sir. Sir, you mentioned about good loan and bad loan. So my question is, how do you differentiate a good loan and a bad loan? Is it based on the person's needs and the person's emotional character and behavior, or is it based on any other different factors?
Oh, according to me, it is very, very simple. It is like in the entire personal finance and investment, my entire approach is to remove the behavior aspect of it. If
Okay,
you
sir.
evaluate each and every money question, or when I'm saying I'm consciously using the word money, I'm not using personal finance, investment, insurance, nothing. Anything got to do with money, if you approach it in a quantifiable manner and in a practical manner, you will automatically eliminate the emotion or the psychological thing.
Okay.
Having said that, a good loan, okay, you should always take a loan for an asset which always appreciates.
Okay, sir. I understand.
So there are only two kinds of loans as of now. The third one is also there, but I'll spell it out later. The first is a home loan.
Yes, sir.
Okay. The second loan is an education loan because both of them add value. Okay. Over a period of time, it will add value. Which loan one should not take? What is a bad loan? You should never take a personal loan. You should never take a credit card loan. For the simple reason is they are given to for personal consumption. That means you consume, it is gone, it has disappeared, so that it doesn't appreciate. Okay, so hence it is not surprising if you look at the interest rates on these loans also. The lowest is on the home loan and the educational loan.
Yes, sir.
The personal loan, the credit card loan is the highest, 36%, 40%, and all of that annualized. When you look at annualized,
Yes, sir.
personal loan is also very, very high. So it doesn't make sense at all to take that because it is, forget depreciation. The asset is not only getting depreciating, it is actually disappearing if you take it for a personal loan or credit card loan. In a home loan, it is at least appreciating. The underlying asset is appreciating. That's one way of looking at things. The second way of looking at things is never ever take a loan whose interest rates which you are going to pay is more than 2 times the inflation rate.
Okay, sir. I understand.
Okay, because there is no way you are going to able to repay the loan.
Yes, sir.
Okay, there is no way because try and understand. Whenever you take a loan, it is not only the interest that you are going to pay. You have to pay the principal also,
Yes, sir.
right? Now let's take a loan of a personal loan where let us assume you are going to pay 15%.
Okay, sir.
15%, let us assume you are borrowing 100 rupees, you have to pay 15%. And let us assume you have 5 years to repay,
Okay, sir.
right? So that means every year you have to repay at least 35.
Yes, sir.
How did I get 35? 100 divided by 520
Yes, sir.
plus 15. So every year you have to repay 35. Now you should be earning at least 35% on your investment to repay this, right?
Yes, sir.
Which business give you that return? Tell me.
No, no business, sir.
Exactly. So hence you should be very, very conscious of doing that. In a home loan, what happens, or in an education loan, what happens? You have a 20-year period to repay the principal.
Yes, sir.
And that 8% you get tax free. Or you're not tax free, you get tax rebate on that.
Okay, sir.
Okay. And in the initial, you're only going to pay the principal. Interest is more, principal is less. And you are already calculating not more than 40% of your income goes into paying the EMI. There is in the back end, without that, they will not give you the loan also.
Yes, sir.
Okay, in education loan also, you get something like 8 year, if I'm not mistaken. Between 8 to 10 years, you get to repay your educational loan in that sense.
Okay.
So, and your EMI does not, you have an option not to start your EMI till the time you don't get a job, or at least 6 months after the course gets over. So you have that kind of a flexibility. And once you take the loan for an education purpose, you are going to add value to yourself, which means you are going to earn more,
Yes, sir.
which is not going to happen with respect to a credit card loan or a personal loan.
Yes, sir.
So always use this benchmark. So it is not about the absolute number once again. So today our inflation is between 6%, 7%, whatever. Okay. Tomorrow it might come down. But always use this thumb rule. Never take a loan which is where the interest rate is double the inflation.
Okay, sir.
So then there is automatically a self-discipline happens.
Okay, sir. Sir, my next question is, you have almost 22 years of experience. I think you know it. At the start of your career, there is no internet, there is no boom of internet, and getting data is a major issue. So my question is, what are today young adults missing despite having this much of information? Because there are a lot of financial mistakes that young adults make today. So what's your view on this?
One thing which always helped me, right from my first job, even when I was doing an intern, I was an intern in an equity research firm. My first project was to do a field survey,
Okay.
on the ground survey, on the ground research. I will give you the practical example. I was doing survey on consumer electronics products,
Oh,
TV,
okay.
washing machine, fridge, music system. I was checking out which brand is selling more,
Okay, sir.
which and what model was selling more in terms of TVs, like what size of the screen is selling more, what kind of, whether it is flat screen or the picture tube one, in terms of washing machine, whether it is semi-automatic, fully automatic, in terms of fridge, double door, single door, what liter, all those things. So it was like which product, first of all, which product is doing well, what model is doing well, what brand is doing well.
Okay, sir.
You do it for multiple areas within the multiple location.
Okay, sir.
Then you go back, then you start doing desk research, marrying demographic data to your field research and find who is going to earn more market share.
Okay,
I
sir.
think so. That market research is what is missing today. You are relying too much on historic or somewhere else, but you are failing to understand what is really happening on the ground.
Okay, sir. I understand.
That is one. Second thing is, I don't think so. People are anymore doing a 360-degree analysis of a particular company. When I'm saying 360-degree, what does a company do? A company is working not only for the shareholders, stakeholders, right?
Yes.
They are working for the banker also,
Yes, sir.
the banks. They are working for the supplier.
Yes, sir.
They are working for the customer. Their decisions are influenced by competition.
Yes, sir.
Okay. Their growth is dependent on government policies. So I already narrated you 6 different entities.
Yes, sir.
You have to speak to important people from this to get a perspective about what that company's potential is. So unless you do this along with this market research, your understanding about the potential and the growth opportunities of that company as well as that industry will be limited.
Yes, sir, I understand. So, my next question is, what's the simplest and safest way for students and early earners to start their investment, sir? Because while entering at the initial stage, most people don't know what financial investing is. They realize it in the later stage and regret that they didn't do that in early. Also, they fear a lot of risks around the financial market. So, what's the safest and simplest way, sir?
Okay. So I typically have a 6-step process, but
Okay, sir.
I will try and answer this across the age spectrum. Okay.
Okay, sir.
So whether you're a 20-year-old in your 20s, just after college, once you go to 30s, and once you even retire or whatever. So I will do it across the age.
Okay,
So
sir.
in the first of all, I'll repeat the 6 steps first. First step is to know your emergency funds.
Okay, sir.
Okay. So when you're having the first salary, obviously you can't do 3 months or 6 months of your emergency fund. But first you should start developing that,
Okay, sir.
because that is a very important foundation for you to have.
Okay, sir.
The second is take an adequate medical insurance. Either you should be taking for yourself, don't rely on the company in which you're working for your medical insurance. So
Okay.
either you should take it yourself or you should be part of your family's insurance policy as
Okay,
a
sir. I
group
understand.
policy of your parents. But start contributing towards it. The sooner you do it for yourself, you'll get to know. Okay, that's the second one. The third is utilize the provident fund which your organization deducts. Okay. If your organization does not deduct the provident fund, then you open a PPF account, public provident fund account.
Okay, sir.
Okay. This is the third thing that an individual do. And once he settles in, has more surplus, because in the beginning you don't even know what is your cost is.
Yes, sir.
You have never run a house, you don't even know unless you're actively involved in your family's expenses, you're contributing and all. If you don't know, then you're trying to just learn the entire ropes. Okay, so once you do this, then anything surplus you have, invest in a balanced advantage fund.
Okay, sir.
Okay, to start with. Okay, before you try and understand what are the asset classes, this is relatively a safer thing. It's like a bread and butter for at any cycle in that sense.
Okay, sir.
So these are the 4 things what a starting individual should do. Okay. Now, once you get into your 30s, once you understand your lifestyle cost, all of that, once you know there is responsibilities on you with respect to the financial commitments, then apart from these 4 things, you should have a term insurance.
Okay, sir.
Okay. So, because now I've told you how to quantify your expense, you will know that, based on which you will know how much you will take for your retirement, because the planning has to begin much earlier, right? You will get to know how much is required for retirement. You will also get to know if you want to do any further studies, how much it could cost. So your financial goals can also start. Then, in case if somebody gets married sooner or whatever, and they have kids, they also know the responsibility towards that family, whether in terms of child's education, child's marriage, all those things can get calculated. So your term insurance will be a function of this.
Okay, sir.
Okay, if somebody wants to buy a house, so then how much is required for that? At least their own initial contribution, they will get to know. And if they are taking a loan, that loan amount also become a liability. So hence they have to take an insurance accordingly to do that.
Yes.
So calculating the term insurance becomes important, because now you are financially responsible for more people and more reasons.
Yes, sir.
And having said that, build on your PF, PPF, and balance advantage fund. Start enhancing that amount as well, apart from the term insurance.
Okay, sir.
Because I'll give you a very classic example. During COVID, emergency funds, Mediclaim, Term insurance, everything got tested
Yes, sir.
of everybody.
Yes.
There was not even a single soul in India who never got tested in all the three. Everybody got tested.
Yes, sir.
People who had adequate amount of all the three did not have stress. People who did not have even one of them were feeling stressed. And that's where your wrong behavioral decision happens.
Yes, sir.
Okay. So hence the foundation of any personal finance and investment is emergency funds, mediclaim, term insurance, and this government sponsored schemes like PF, uh, PPF, and other things which are like forming your strong opinion, strong foundation, and to some extent the balance advantage. These are the four pillars based on which it will grow. Once you fulfill your obligations and all of that, then you can think about slightly more riskier products, other things and all. But unless all your financial responsibility are not met with these four pillars, don't even think about doing anything extra.
Okay, sir.
So just to connect to your earlier point, the fear and hope, you will not have to live with fear and hope if you do these four things properly.
Okay, sir. I understand.
You do this, so it is like you're building your house, right?
Yes, sir.
You spend more time and money in the foundation,
Yes, sir.
not in choosing the paint or the furniture or the painting that you want to put in the wall
Yes, sir. I understand.
or the fittings in your bathroom or whatever. Lot of money goes into the foundation which you can't even see. That is the way even the personal finances put lot of effort and time on the building the foundation.
Okay, sir.
And the last element, so once in your 40s or in your early 50s, the sixth element is writing a will.
Okay, sir.
Okay. But starting from 30s onwards, ideally they should write a will as soon as possible. But if they still have not decided, but at least communicate about the where all your money related items are to your spouse or the next most important member in your family.
Okay, sir.
So it is about where the bank accounts are, where the insurance policies are, or what are those policies, term, medical, everything. Where all the mutual funds are, if you have somebody has demat accounts, investing shares, where they are, who are the agents, who are the brokers, who are the advisors, list down all of them. Have you done nominees everywhere? Because if you don't have nominee, you will have a problem.
Okay, sir.
Yeah. So what I was trying to say is with respect to the will, while you might be writing the will, you would have decided everything. But if you don't have the nominee, it will be very, very difficult for somebody to get possession of all the assets. So you have to ensure that there is nomination in each and every asset of yours. So not only in your bank account, but even in your house, even in your demat account, even in your mutual funds, even in your insurance, everywhere there should be nomination. I will tell you a matter of fact. There is close to 1,40,000 crores lying with various financial institutions which have not been claimed.
Okay, sir.
So it is a combination of not having a nominee, not having a will. It's a combination of various things. So the family members do not know where the money is. The government does not know who to whom it has to be handed over. So it is nobody's baby. So it's not at all a win-win proposition. It's a lose-lose proposition.
Yes, sir. I understand.
So it is a great sin, if you ask me, if I can use that word a bit strongly, for somebody to not to do this. Because you have saved for your near and dear ones, and if they can't get access to it, you might have as well enjoyed it and not saved it.
Yes, sir. I understand, sir.
So I will once again repeat, emergency fund, mediclaim, government sponsored schemes, term insurance, balance advantage fund, will. 6 things. Simple.
Okay, sir. I understand.
It's
That
okay.
was I think that was the basic foundation of somebody to plan their finances.
Yeah.
Yes, sir.
And you're sorted. Nothing can shake you from them. You have a strong foundation
Okay, sir.
in that sense.
So my final question is there a financial mistake or a turning point that completely changed the way you look at finance today, sir? Even in your younger days or start of the career?
Oh, yeah, yeah, very much. Exactly. So I will share to explain that, I will share a screen for you right
Oh,
now. Can you see?
yes, sir.
Can you see the screen of my?
Yes, sir. Yes, sir.
You
Yes, sir.
can see a graph, right?
Yes, sir.
Okay. So before explaining this graph, what this graph is, I will tell you a thing. Look, throughout my life, whether I've done MBA finance, I've been a commerce graduate, I've worked for 22 years in financial markets, nobody has explained the science behind how the markets work, how equity, when and under what circumstances equity markets rise, under what circumstances just debt market does well, what circumstances real estate does well, not on there. I found interest rates
Yes, sir.
subsequently is the single most variable based on which all markets revolve.
Okay, sir.
You can think about it that Lord Krishna's finger
Yes.
surrounding which that Sudarshana Chakra is revolving. So this is that interest rates. And this is not only an Indian phenomenon, it is a global phenomenon.
Okay, sir.
Okay. Everywhere, interest rate is what closely is tracked. It is tracked by right from the finance minister to the your automobile seller, your vegetable vendor, everybody is directly or indirectly tracking this.
Yes.
And their life gets affected with this.
Yes, sir.
Now, this interest rate, incidentally, is an dependent variable. If you understand, right? Statistics, independent variable, dependent variable.
Sir.
In economics, independent variable and dependent variable. In statistics, they have
No.
variable. When you're writing a regression equation, you understand regression equation,
No, sir.
maths, statistics.
No, sir. I'm from engineering background, so I don't know all this.
Also, in engineering background, also they need to have that. So, okay. Uh, I don't know whether I can say Newton's third law. For every action, there is an equal and opposite
Yes,
reaction,
sir. Yes.
right? So the reaction is an independent of action.
Okay, sir.
Sorry,
I understand, sir.
a reaction is dependent on
Action.
action. The reaction is so in which sense action becomes independent.
Okay, sir.
So action is an independent variable. Reaction is a dependent
Dependent
variable,
variable. Okay, sir.
right? So here, similarly, interest rate cycles, the interest rate is a dependent variable. So which is the independent variable? Inflation.
Yes, sir. I.
Inflation is the independent variable.
Yes, sir.
So first inflation happens and then the government or through the central bank of the nation. So in our nation, it is RBI, Reserve Bank of India. They try and monitor or intervene with respect to the interest rate to monitor that. So this is the interest rate cycle, interest rate of over the last 25 years of India.
Okay, sir.
So the thing that I've used is a 10-year Government of India
Okay.
security. 10-year GSEC is what it is called. Over the last 25 years, I've shown it. You'll think that it is only historically going down.
Yes, sir.
You can see my arrows. It is going down only.
Yes, sir.
Okay, that is what people will think. But actually, if you notice, it is not going down.
It is in a
It
range.
is actually moving in a narrow band.
Yes, sir.
Okay. Now, if you think closely, 1 second. If you see closely, it is somewhere closer to 6% where it is touching and then falling and then going up. This is
Yes.
not, I'm not doing a technical analysis. Huh? Don't Assume
Okay,
that
sir.
this is a technical analysis.
Okay,
I'm
sir.
trying to
Okay,
give you a fundamental measure.
okay, sir.
And then once it crosses close to 9%, it starts falling once again. So
Yes, sir.
that is the band. 80 to 90% of the time over the last 25 years, this is the way it has been.
Okay, sir. I understand.
Okay. Now I will show you an interesting part. Whenever the interest rates are falling, okay,
Okay, sir.
equity does not do well, debt market does well.
Okay,
So
sir.
in the initial period, equity was down 34%, debt was up 78%. This
Okay.
was somewhere between 2000 to 2003. In the next cycle, from the bottom to top, equity was up three times, close to 300%. Debt was up only 18%.
Okay, sir.
Okay. So when the interest rates are falling, debt does well.
Yes, sir.
Equity does not do well. When the
Yes.
interest rates are rising, equity does well, debt does not do well.
Okay, sir.
In financial market parlance, equities underperforms in a falling interest rate regime,
Okay, sir. I understand.
or debt outperforms equity in a falling interest rate regime.
Okay, sir.
Equity outperforms in a rising interest rate regime. So this has happened like a pattern consistently every time. One, two, three. The second time, this is a 2008 crisis when
Yes,
equity
sir.
fell 34%,
And
debt increased by 27%.
okay, sir.
Then up to 2013 or 2014, equity was up 100%, debt was up only 11%. So equity outperformed. Here, even though equity between 13 and close to 20, every time equities were making all-time highs. In a net, just after COVID also, equity was actually underperforming debt. So even though
Yes.
it grew by 50%, actually debt market did well.
Yes, sir. I understand.
And till recently, after that fall, equity has done close to 2.5 times, debt has done this. So this thing, nobody taught me. If they had taught me much earlier, then my entire approach towards personal finance, or for that matter, my recommendations, my research, everything would have changed.
Okay, sir.
So I'm not telling all your viewers to adopt only this. They need to understand what drives markets.
Okay, sir. I understand.
Okay. So once they get to know that, so they can develop their own tools. They have this tool, they can develop their own tool. So now I have also developed a tool much beyond this. So I'm following that tool for my own stuff. So
Okay.
sooner they realize this, better it is for them. That is a very, very important thing from their professional development. So they can be working anywhere. They need not work only for financial markets or whatever, because even though you are a, trading institute in that sense, even if they are working in a manufacturing entity, if they want to do anything, something like this will always help them in trying to understand the science behind what is driving things.
Okay, sir. I understand, sir.
Okay.
Thank you, sir. That was a good, great podcast. I learned a lot.
I would like to I would like to proactively give the philosophical suggestions,
Yes, sir.
because I believe most of your audience are students, right?
Yes, sir.
Or they are going to enter into the job market for the first time, right?
Yes, sir.
If
Yes,
I'm
sir.
not mistaken. So I'll give you a philosophical suggestion once again. Actually, it is very, very practical. Through my own experience, I've noticed it, but it
Okay.
has a philosophical twist to it. I've noticed in my own life, every decision, okay, whether it is personal or professional, more importantly, professional, which I tend to regret much later in my life, okay,
Okay, sir.
are those decisions where one of the three things I was very weak in.
Yes, sir. Okay.
Okay, now what are those three things?
Yes, sir.
One is obviously what we just discussed is financial health.
Okay,
So I
sir.
put it as health trinity. One, financial health. Second, emotional health.
Okay, sir.
Third, physical health.
Okay, sir. I understand, sir.
Okay. Now, when I'm saying this, I'm not saying you should be very strong in one of them. And if you're weak in other two, it will offset. No. All the three have to be in similar balance. It has to be in balance.
Okay, sir.
And excess of one will not offset deficiency in the other two.
Okay, sir. I understand.
So think of it, your listeners should think of it like a ceiling fan.
Yes, sir. Okay, sir.
So where, because you are an engineer, you should understand, even there are three arms to a ceiling fan. So three arms to an individual's health.
Yes, sir.
Okay. So one, physical, emotional,
Financial.
and financial. Even if one of the arm is twisted or broken, the fan will not give you the right quantity of air,
Yes.
right?
Yes,
It will
sir.
not work properly.
Yes, sir.
Okay. You can increase the speed, it doesn't work.
Yes, sir.
Instead of 220 volts, you put 440 volts, it will not work. Similarly, with an individual decision making,
Okay, sir.
your decision making will get impacted even if one of them is not in same balance. You need to have it in balance, not in excess.
Okay, sir. I understand.
So if you have it in balance, each and every important decision, actually all decisions, but more importantly, the important decisions, you will take it on the right merit. You will address it on the right merit. You will not get merit of the problem in the right merit and not evaluate it based on materialistic aspects.
Okay, sir. What
Like
is
what happens to the promotion, what happens to my money,
yes.
whether I will get bonus or how whether I will get into physical harm, what happens to the how will I conduct myself in social media if I say that such and such a thing has happened. Ignore all of that
Okay, sir.
because all these things are the social media thing is an emotional thing that is not going to help you in your long career. That is not going to help you. Your overall conduct is what is going to help you.
Yes, sir. Okay, sir.
Okay, so your ability to analyze the situation on its merit, on its importance, keeping the material aspect aside, only if you have all these three in balance, you will be able to do it. It has been my own experience that whenever I've taken decisions when all these three was balanced, the rewards was significantly better.
Okay, sir.
Okay, and life became very easy.
I understand.
Okay, and it was like a cakewalk. Okay. The respect that individual I got when I took such decisions was significant. But at the same time, whenever even one of these three legs were health was weak, and I took such a decision, I tend to regret later in life.
Okay, sir.
So this is a proactive recommendation and suggestion from my side to your audience. Because you're starting your career, ensure don't take decisions based only on one of these three criteria, but on a balance. Only when you have a balance on all of this, you will reach far ahead in life than you can think about.
Okay, so that was a great advice, sir, because I also don't focus on my physical health while working, sir. So it will help not only me, but also my peers who don't focus on any of these factors.
And when I'm saying physical health, don't only by getting a six pack doesn't help. Huh?
Yes, sir.
Only we get a six pack, that doesn't mean you're physically healthy. There are marathoners who are having heart attacks. So it is the definition of a physical of being healthy in all the three is simple thing is if as and when a problem occurs, you should be able to dust yourself, rise, and continue.
Okay, sir.
There shouldn't be a mishap.
Yes, sir.
Okay. Like if you have a mental health issue, then you will go into depression, into all the sort of problem. If you get into physical injury, you will get admitted to an ICU.
Yes, sir.
Those are like extreme situation. That shouldn't happen. You get a
Okay.
physical injury, you go to a doctor, physician, take an injection or whatever, take medicines, whatever, you are up and running.
Yes, sir.
If you have an emotional problem, if you think that you can handle it yourself, so be it. But the moment you think you can't handle it, take some help from expert doctors and do it. Similarly,
Okay.
financial health. So the right way of analyzing is you know how much you can do by yourself and how much you need to take external help.
Okay.
That is the yardstick of deciding whether you are healthy or not.
Okay, sir.
Not having 10 crore balance in your bank account or your shares, or not doing 3 hours of meditation and 2 hours in the gym to develop a six pack. That is not a yardstick.
Okay, sir.
Your yardstick is how quick you are able to overcome a mishap and be up and running and take the right decision which you never regret in future.
Okay, sir. Thank you, sir. Thanks for your time. It was a very useful session. I got a lot of insights from you. Thanks for coming to our
Happy,
podcast, sir.
glad, and I sincerely hope you guys benefit from this and happy to interact further. If anybody have any doubt, please reach out. Happy to do it again and again in that sense. And thank you very much once again for inviting me and giving me this opportunity.
Okay, sir.
Thank you very much.
Okay, sir. If you find this video useful, kindly like our video and share your opinion in the comment box. And share this video with your friends to learn more about finance and life. And also subscribe to our YouTube channel for more finance related content. And don't forget to check out our app on Play Store. Thank you.